Hello, my name is Eric Yang, and welcome back to another episode of Jhin Seok Stock Talk. Today's lesson, stock valuation. So, what am I going over in today's video? Today, I'll be going over 5 basic points of stock valuation, including market capitalization, enterprise value, P&E ratios, shortfalls of P&E ratios, and EV and EBITDA multiples. Starting with market capitalization. Market capitalization, otherwise known as market cap, represents the total value of a publicly traded company. And there's a very simple formula to understand the market capitalization of any company. It goes as follows: total number of shares outstanding, meaning however many shares the company has available to sell, multiplied by the company's current stock price. So whatever that may be, from a penny to $300. Um, the main importance of being able to understand how to value market cap and calculate market cap is that it helps you visualize the sheer size of a specific company, and you can compare like how safe a company is to invest. For example, a smaller company would have a smaller market cap, and with a smaller market cap, it has potential for the company to grow, but that could be seen as a more risky investment. On the other hand, a bigger company will have a bigger market cap. However, the company doesn't have much to grow, so your profits um, are not going to be crazy big. However, if a company is able to get to that size of a big market cap, it's proven and is able to show that it is a stable company to invest in. Next, we have enterprise value. So enterprise value is simply the entire value of a company, and just like market cap, there's a simple formula to be able to uh, calculate this. So you take the market cap, as we just talked about before, and you have the total debt, meaning whatever amount of money that they owe um, is added to the enterprise value, and you subtract the total cash, meaning even if the company has cash, you can subtract that. If the company has any liquid assets, those are all deducted, because those assets can be used. It can be turned into cash, and then can pay off the total debt, which is why the cash gets uh, deducted from the debt. And the enterprise value is significant because, well, if you're trying to invest in something, obviously you're gonna want to know what the value is, or if you want to buy off the company, you're gonna want to know how much you need to buy off, and um, how much you're gonna have to pay, pretty much. Next up, P/E ratios, otherwise known as price to earning ratios. This is an easy way to measure how much you are earning from stock from each dollar that you are paying to have the stock. So, why is this significant? Well, it's very obvious. Obviously, if you're going to invest in something, you're going to want to know how much you're getting back from it. That's the whole point of investing. And the formula to figure out P/E ratios for any investment is as follows: share price divided, meaning how much you're paying for the share, divided by earnings per share, which is easily calculated through the company's net profit divided by divided by the number of outstanding shares. So um, this is a very simple ratio that um, everyone in the finance industry uses to be able to figure out how much they're earning for their investments. Next, shortfalls of PD ratios. Although it may seem like PD ratios are very useful and can easily figure out the next best investment, or how to get rich quick. However, there is one shortfall that comes with using PD ratios, and that is that PD ratios are based on historical data, meaning it doesn't tell you how much you're going to make in the future. Just because the company blew up in the past doesn't mean the company will continue to blow up. And just because the company was declining in the past doesn't mean that it's gonna. That means it doesn't mean it can't swing back up. So that's the one major big shortfall of PD ratios, is that it's all based on historical data and things that haven't happened yet, so you can't really tell. Like, just because a PD ratio, a solid PD ratio in the finance industry is around 20 to 25, and even if there is a stock that has a PD ratio of 20 to 25, it doesn't guarantee that you'll be making money off of your investment, because you never know what can happen to an investment. Next, EV and EBITDA multiples. The enterprise multiple, known as the enterprise value divided by earnings before interest, taxes, depreciation, and amortization, is another valuation tool that is used to measure a company's ROI, or return on investment. How many earnings you're making on your investment. Um, and although it may seem a little more complicated, this tool is actually a lot more preferred compared to the P&E, because it doesn't have major shortfalls, and it's a way better representation of the company's financial performance. So there's a simple formula to figure out EBITDA multiples, and that is the EV, which is the enterprise value, divided by E, the net income, plus the I, interest, plus the T, taxes, plus D, depreciation, and A, amortization. Now, if it sounded like I was just spitting random letters, I'll be able to represent a clear cut, like, visual on how this formula actually works. We have the EV, which, as we went over earlier, is the total market cap plus the total debt minus the total cash. So now that we have that, we have the EV divided by the E. Hold on, let me make this a little thicker. There we go. EBITDA. And in this, hold on, it's a little too thick now. Okay, there we go. And in EBITDA, pretty much the B doesn't really matter, because the B is only specifying that it is the E, which is the net income before all the other stuff. So hold on, let me write this all out. So pretty much what this means is earnings. I don't need to write it out. Earnings before interest, taxes, depreciation, and amortization. So to figure all this out, to figure out what this bottom part means, we put E is equal to net income of a company, which is pretty much how much money do they make? How much money do they make at the very end, after all taxes were paid, after everything was paid? What is their net income? And now we have before. Earnings before. So now we have interest, which is payment they have to do on loans, mostly loans, because usually you take out loans and you pay them back on timely payments. So interest, because you have to pay this back. This is like another necessary payment. Taxes, another necessary payment that companies must do. Corporation taxes. Now depreciation. Depreciation is pretty much an annual tax reduction that allows you to recover on the depreciation of your assets. So pretty much, because all assets have a depreciating rate for its useful life, it could be anything with a car, mostly cars. Like if you buy a car for $40,000, after 1 year of using it, it's gonna drop, and this tax reduction allows you to recover on that loss of the value of your assets. And now we have A, amortization. So pretty much what amortization is, it pretty much helps you plan out your loan payments. So it's another form of payment for loans, pretty much. Amortization. And you add all of these things together, and you have your total earnings before all of these are deducted from the total earnings. And you divide that by your enterprise value, or your EV, and that's how you get the EV EBITDA multiple. So that is pretty much the explanation of EV EBITDA multiple formula, and it's very preferable because, like I said before, it gives a clear cut picture of the company's financial performance. And that is all for today's video. Thank you so much for tuning in.